There are countless ways to invest your money, countless portfolios to sift through, and a variety of metrics to track, and they all hold different levels of importance depending on the financial situation and goals of each individual investor. For instance, an investor in their early 20s with a good education, job, and budget has lots of time ahead of them to recover from any investing misses or errors in judgment. Therefore, they may tend to value the potential for larger long-term growth even if it comes at the cost of more volatility in the short term. Others may be at a point where they have more or less enough money to do what they want to do going forward, but aren't quite to the point where they're looking to retire yet. As a result, they may tend to value a portfolio that seeks to avoid large and unexpected losses, even if it comes at the cost of some potential long-term growth. The Larry portfolio falls into a specific segment of that camp. Unlike something like the permanent portfolio, which seeks to perform reasonably well under a variety of economic circumstances, the Larry portfolio seems to separate itself from the pack by setting itself up in the way to specifically avoid those sudden, large, and unforeseen losses that can occasionally happen in markets. These events are often called Black Swan Events, and as we've covered previously on this channel, and unfortunately seen in real time in 2020, they can pretty much wreck your finances if you aren't prepared for them. Now, that doesn't mean that it doesn't try to avoid the worst of other economic downturns or eke out as much growth as it can, because yeah, it does, but it seems like when push comes to shove, it's more interested in handling those black swans than it is in maximizing its performance in other metrics. And given the recent events, I thought that it would be interesting to look at the Larry portfolio to see if it's actually managed to achieve its goal, both historically and in this most recent downturn. So, let's talk about the Larry portfolio. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. The Larry portfolio, created by Larry Swedroe, splits your investments up into 4 different assets: intermediate-term treasuries, domestic and international small-cap value stocks, and emerging market value funds. The intermediate treasuries comprise a whopping 70% of the portfolio. The international small-cap value stocks and the emerging market value funds each take up 7.5%. And the remaining 15% is put towards those domestic small-cap value stocks. Unfortunately, similar to the Merriman Ultimate portfolio, I'm going to have to make some slight alterations here due to the fact that I just don't have data going far enough back on all of these categories. The ones that I'm missing are the international small-cap value funds and the emerging market value funds. I do have data for the blended international small-cap funds and just blended emerging market funds, so that's what I'm going to use in their place. But just know that this is going to be a somewhat modified version of the portfolio that Swedroe proposed. What you'll notice immediately is that this portfolio has a pretty conservative leaning. With over 2/3 of the money being invested in bonds, we would expect overall volatility to be significantly reduced when compared to a more stock-heavy strategy. However, the 30% that is invested in equities is skewed a bit more to the higher end of the volatility spectrum. Generally speaking, small-cap funds have generated higher average long-term returns than their larger counterparts, at least historically. But due to the fact that they have very few resources to draw on during economic hard times, they also tend to be more volatile in the short term. You could say something similar about emerging market funds, which in good times can produce very respectable returns, but do tend to come with comparatively higher downside risk. So it'll be interesting to see if the bonds can continue to counteract the impact of stocks volatility during the more drawn-out economic downturns. Or if the choice to go small and try and eke out slightly higher overall returns will end up leading to the Larry portfolio being placed behind some of the more stable allocations we've covered already in terms of their tranquility, without actually being able to provide enough of a boost in those returns to keep up with some of the more growth-focused strategies. And even though at the time of this recording, in mid-November 2020, we still appear to be far from out of the woods with this most recent downturn, given that it does qualify as a Black Swan event, I do want to take some time at the end of the video to analyze how the Larry portfolio and other strategies that we've covered on this channel have been doing so far this year to see if it's been punching above its weight, so to speak, in terms of that stability. But with that being said, let's get started by analyzing the historical long-term returns of this strategy. To analyze the returns, we'll be looking at a few different metrics. We'll be looking at the long-term 40-year inflation-adjusted returns for every year starting from 1976 through the end of 2019, since at the time of this recording, that's the first and last years for which I have complete data on all the assets involved in this strategy. We'll also be taking a closer look at the rolling 10-year returns to make up for the fact that we only have a handful of the 40-year stretches during this time period. We'll also show how other strategies perform during these years to get a more apples-to-apples comparison. In addition to returns, we'll be paying particular attention to how many times the portfolio lost money and, more importantly for this strategy, how severe those losses were. Finally, we'll touch on how dependable or trustworthy the strategy has been by examining how sensitive those long-term returns are to when you decide to start investing. So based on the data that I have, since 1976, the average 40-year inflation-adjusted return for the Larry portfolio is about 5.4% per year. Its worst-case return was around 5.2% per year, assuming you began investing in 1977, and its best-case scenario was an average return of around 5.7% per year, assuming you began investing in 1980. That suggests that a $10,000 investment would grow to, on average, around $82,000 over the course of 40 years after adjusting for inflation. At worst, you're looking at a nest egg of around $76,000 and at best, $91,800. Now, compared to the other strategies we've covered so far on this channel, those returns are not great. In fact, outside of the permanent portfolio's 4.7% average return during this same time frame, it's the worst we've seen. But again, returns were not the highest priority of this strategy, so while it's unfortunate, it's certainly not a deal breaker. Next, let's take a look at some volatility metrics. The average standard deviation of returns for the Larry portfolio was a mere 7.2%. Which means that in any given year, we can expect that most of our returns will fall somewhere between negative 1.8% and 12.6% with this strategy. Roughly 64% of the annual returns fell within this expected range in our sample. This is a remarkably low level of year-to-year volatility. A 7.2% standard deviation of returns since 1976 actually places the Larry portfolio at the top of the pack compared to the other strategies we've covered so far. Even the incredibly tranquil permanent portfolio had a standard deviation of 8.5% during this same stretch of time. And the more stock-heavy allocations, like the all-stock strategy and the Merriman Ultimate portfolio, were more than twice as volatile, with standard deviations of 15.8% and 16.3% respectively. As far as losses go, there were a total of 11 years out of a possible 44 where the portfolio failed to keep pace with inflation in this sample. That's a loss frequency of around 25%. Thankfully, those down years were recovered from quickly as there wasn't a single 10-year stretch where the strategy failed to keep pace with inflation. And similar to the Merriman Ultimate portfolio, it never even got particularly close. During its worst 10-year stretch, which was from 2010 to 2020 actually, it still managed to earn an inflation-adjusted 3.3% per year. Now, since this dataset only goes back to 1976, we are missing out on quite a few major economic events, most notably the first downturn of the 1970s and the Great Depression. But at least over the last 4 decades, those are encouraging results. Its median and average 10-year inflation-adjusted returns were 5.5% and 6% per year respectively. And its best 10-year run was from 1982 to 1992, where it returned 10.4% per year over inflation. Next, let's talk about start date sensitivity. Start date sensitivity, at least as we're measuring it in this series, takes a look at the rolling returns of the 10 years prior to each initial investment starting date and compares it to the rolling returns of the following 10 years to see how big of a difference there is between the two. It's a good way to get an idea of how dependable or trustworthy an investment strategy's returns have been historically. And ideally, we want to keep our total start date sensitivity, measured here by the difference between the largest overperforming decade and the largest underperforming decade, as low as possible. The Larry portfolio had a total start date sensitivity of just 7.7% during this time frame, which actually makes it the third least sensitive portfolio that we've measured, at least during this span of years, narrowly trailing the Golden Butterfly, which had a total start date sensitivity of 5.1%, and the permanent portfolio, which clocked in at 6.2%. The largest overperformance for the Larry portfolio was 2.8% per year, which took place from 1986 to 1996. In those years, the strategy had an inflation-adjusted return of 7.7% per year, beating out the returns from 1976 to 86 of 4.9% per year. The largest underperformance was negative 4.9% per year when the returns from 1992 to 2002 failed to match those produced from 1982 to 1992. But that just about wraps up our analysis of this strategy's returns. Now, let's move on to our crash analysis. A crash analysis is always important to do for any investing strategy you're looking at because it's important to know that if you're going to be putting your life savings into something, that you'll be able to weather the storms when they come, both financially and otherwise. In these videos, we look at a few different metrics when analyzing the crashes. They are how deep the crash got at its worst, how quickly the strategy typically recovered from said crashes to reach new highs, and the Ulcer Index, which largely combines the other two metrics into a single number. The longest and deepest drawdown for the Larry portfolio took place over the course of 5 years from 1978 to 1983. During those years, it trailed inflation by as much as 14% at its worst. However, as we've covered a few times in this series, the 1970s and early 1980s were times of considerably higher inflation than we typically experience today. During that span of years, the CPI jumped by an average of 9.4% per year, about 56% in total, from 62.5 to 97.8. So based on how the data in the spreadsheet for this series is set up, this is the worst crash for the Larry portfolio. But the portfolio would have actually been growing during that time, just not quite fast enough to keep up with that high inflation. As far as the other major downturns of note, we have the flash crash in 1987, the dot-com crash, and the Great Recession. I'll save the still ongoing downturn of 2020 for the end of the video so that we can compare all the strategies we've covered so far at the same time. From January 1987 to January 1988, the portfolio fell by an inflation-adjusted 1.6%. Inflation for that year was about 4%. So while the portfolio did fail to keep pace with it, it did technically grow in nominal terms. And it would go on to set a new high by the time 1989 rolled around, so all in all, not too bad of an outcome. The dot-com crash looked even better, as there wasn't a single year between 1996 and 2008 where it failed to keep pace with inflation. The portfolio did fall by around 2.3% between January 2008 and January 2009, and given that the CPI was largely flat during that time, it does represent both a nominal and inflation-adjusted drop. However, similar to the flash crash of 1987, the Larry portfolio would again set a new all-time high by 2010. So it was down, but not for very long. Again, all things considered, this isn't too bad. The Larry portfolio's worst crash of 14% is the least severe of any portfolio we've covered so far during this time frame. The permanent portfolio was a close second with a crash of nearly 17%. And while it technically wasn't the most resilient strategy during this span of years, the no-brainer strategy's longest crash lasted just 4 years despite dropping by 28%, it was in a four-way tie for second best with the classic 60-40, permanent portfolio, and Merriman Ultimate strategies. And the investing experience metrics reflect this solid performance. The Ulcer Index during this time period rose to as high as 0.4 during the mid to late 1980s, but on average it hovered around 0.2. And in recent decades, it's often been even lower, rarely rising above 0.1 since 1995, despite 2 major market downturns in the 2000s. So while I would be interested to see how it would have done during the Great Depression, or even the early 1970s downturn, considering how it struggled in the later half of the decade, it is still nice to know that in recent times, it's been able to hold its own during major market downturns. With that being said, let's move on to examining the strategy in regards to financial independence. Historically speaking, the Larry portfolio would have maintained minimum safe withdrawal rates of 5.75% over any 30-year stretch, and 5.30% over any 40-year stretch from 1976 through 2019. The worst year to retire using this strategy was 1977, as that's when both of these minimums were set. And I should note that, as usual, due to the varying nature of individual expense ratios and tax situations, neither has been considered in these withdrawal rates. The median rates were 7.08% for the 30-year and 5.66% for the 40-year scenarios. And the maximum rates for the same durations were 9.04% set in 1982 and 6.68% set in 1976. The strategy would have maintained a minimum perpetual withdrawal rate of 4.6%. And as usual for this series, I'm defining perpetual withdrawal rate as the highest withdrawal rate that you could have had while still maintaining your original principal all the way through to the end of the dataset, even after adjusting for inflation. So if you've been following this series for a while, you'll notice that, particularly given the time frame we're dealing with, these aren't the most impressive numbers. While it does beat out the permanent portfolio in both cases, it trails every other strategy and often by a fairly noticeable amount. This is likely due to a combination of that lower level of resiliency we saw during the crash analysis and the lower long-term returns we saw earlier in the video. The accumulation phase of financial independence is where you're still putting money away for your future. The primary metrics here is what percentage of our income are we saving, how do our expenses change over time, how long do we plan to be retired, and how long will it take us to reach financial independence based on that information and the performance of our investing strategy. If we assume a 30-year retirement, a 15% savings rate, and that our expenses changed in line with inflation as measured by the CPI, then someone investing in the Larry portfolio would still be waiting to reach financial independence regardless of what year they began investing. With a 30% savings rate, a hypothetical investor would have reached financial independence in 4 of the 44 scenarios. On average, achieving FI with this strategy and at this level of savings took about 36.8 years. The fastest was 34 years starting in 1981, and the slowest was 40 years starting in 1980. With a 50% savings rate, a hypothetical investor would have reached financial independence in 27 of the 44 scenarios, on average taking 16.8 years to do so. The fastest was 15 years starting in either 1981, 1983, 1990, or 1996, and the slowest was 22 years, assuming they started in 1976. And finally, with a 70% savings rate, the numbers improve even further, with an investor reaching financial independence in 38 of the 44 possible scenarios. On average, achieving FI with this strategy and at this level of savings took about 7 years. The fastest was 6 years starting in 1981, 82, or 84, and the slowest was 10 years, again starting in 1976. So similar to the drawdown phase of financial independence, the Larry portfolio struggles to keep up with his contemporaries, at least based on the data I have available to me. It achieves financial independence less frequently than many of the other, admittedly more aggressive strategies that we've covered so far, particularly at those lower savings rates. However, in instances where FI was reached, it did tend to do it relatively quickly. But still, it wouldn't be the first portfolio that I'd turn to if I were just starting my journey to financial independence, or if I were about to make the transition into a drawdown phase for FI. As strong as its showing was in the more recent economic downturns, it just doesn't seem to have enough juice to sustain itself over the long haul compared to some of the other options out there. So on your screen now, you'll see the crash figures for the strategies we've covered so far in this series for the 2020 downturn, through the end of October anyway, as that's the most recent completed month I have available to me at the time of this recording. All figures are using Yahoo Finance's monthly average adjusted closing price data, so we are assuming the reinvestment of dividends with these strategies. The crash depth is how far the strategy fell from where it was at the start of the year. The duration is the longest stretch of months that it went without setting a new all-time high, and it is worth noting that for some of these strategies, a new high was set in the late summer, early fall, and then followed by another down month. The down months are the number of months where the strategy failed to keep pace with inflation. The real ROI is, of course, the annualized inflation-adjusted return for the strategy during this 10-month stretch, and the ending net worth is what someone's $10,000 investment would be worth as of the end of October 2020. What we see is that the Larry portfolio stacks up pretty well to its contemporaries in terms of limiting the depth of the crash. Its max drop of 7.4% from its previous high is second best among this group, trailing only the permanent portfolio's 3.9% drop. However, its comparatively lower resiliency was also on display again with this crash, as it took a full 6 months to recover from its losses early in the year. That's slower than all but the No-Brainer and Merriman Ultimate strategies, which took 6 months and 9 months respectively. What's more is that, at least at the time of this recording, it's produced the second lowest net worth of the group. Its inflation-adjusted ROI through the first 10 months of the year is just 1.6%, which is well behind every other strategy except for the Merriman Ultimate portfolio, which has only recently got its head back above water. All other strategies have managed annualized returns of at least 5% above inflation this year. On the bright side, all 7 strategies have managed to recover their losses from earlier in the year. And while, like I said at the beginning of the video, we're clearly not fully out of the woods yet, that is still a nice thing to see. So that's the Larry portfolio. Based on the data I have available to me, it seems that, in the end, it's a portfolio with a very niche purpose. It certainly does hold up pretty well in terms of limiting the initial damage caused by various Black Swan events, or at least the ones that we've experienced since 1976. And that tranquility is coupled with a healthy dose of dependability, illustrated by the Larry portfolio's low start date sensitivity. But its comparatively lower returns and lower resiliency make it a less attractive option for those investors who are seeking strong performance in a larger variety of economic and financial situations. But what do you think? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.